is a good time to buy a triple leveraged ETF. If you don't know what a triple leveraged ETF is, it's essentially an index fund like the S&P or like the Dow or like the NASDAQ, but when they go up 1%, this fund goes up 3%. It's a popular security type for aggressive investors. Now the strategy here is pretty simple. What people are thinking is since the market has sold off so much recently, now may be a good time to buy the dip. So let's break this down and talk about why it may be a good idea and why it's super risky too. Stocks are on sale right now. Whether you think the markets are going to continue to trend down or whether you think they're going to recover, you can't argue that over the last couple days, they're down a lot more than what they were a couple weeks ago. Totally fair and totally logical. And when stocks recover, like they inevitably will, we just don't know how long that's going to take, those people are going to have triple the returns on the way back up. However, here's the risky part that I want to caution people of. If you invest in an amount now and things continue to drop, the amount of investment gain that you're going to need to have to recover your losses is going to need to be greater than the amount that you lost on the way down. So let me explain this with an example. Imagine you invest $10,000 in TQQQ. That's a triple leveraged index of the NASDAQ 100 fund of QQQ. When you invest in a triple leveraged account, your ability to lose your entire investment becomes magnified. If it loses 30% in one day, which is possible, the NASDAQ was almost down double digits last week. And just remember that because you're in a triple leveraged fund, if the NASDAQ's down 10%, you're down 30%. So when you're down 30% on your $10,000 position, you're down to $7,000. To make that up, you don't need a 30% return. You need a 42.86% return. That's tough, but it gets worse. Now let's say that TQQ drops 70%, which just means 23.33% for the NASDAQ 100 to drop. Now your $10,000 investment has dropped down to $3,000. And to get out of that hole, you need a 233% return. So basically, you need TQQQ to quadruple in order to earn back your investment. A 233% return for TQQ is a 77% return for the regular NASDAQ 100 fund QQQ. Now, QQQ can definitely have a return of 77%. Over the last 5 years, it's had about a 91% return. But again, that means that in order to earn back your investment, you may have to wait years just to see yourself crawl out of that hole. So that pretty much explains it. This is why the buy the dip strategy for an index leveraged fund like TQQQ is risky.